Today, we're jumping right into the pretty wild world of cryptocurrency.
Yeah, it's been quite a ride.
Remember those, let's call them the Trump years? Meme stocks going crazy, NFTs selling for millions?
Oh yeah, and people buying virtual land.
Exactly. It felt like, I don't know, a whole new financial world opening up.
But maybe not entirely new. There are echoes, aren't there? Susan Strange talked about casino capitalism.
Right, and Keynes too. He warned about long shot gambles in unregulated markets. Feels kind of spot on for crypto.
It really does. History doesn't repeat, but it often rhymes, as they say. These speculative booms pop up again and again.
Tulipmania.com.
Same patterns. A powerful belief you can get rich quick, sometimes blinding people to the actual risks involved.
Totally. And that's what we're digging into today. We want to unpack what cryptocurrency actually is.
And the stories, the narratives that drove its popularity.
We're using Ben McKenzie's book, Easy Money, as our guide here. Think of it as a shortcut to understanding this whole thing.
Why did it grab so much attention, so much money?
Yeah, what is it? McKenzie calls his book a parable of fake money and lying for money.
Like a fairy tale, he says.
But he makes it clear this isn't make-believe. This actually happened.
And that's where I hope to add some context, sort of flesh out the analysis a bit.
Great. So let's start simple. What is crypto, fundamentally?
Well, for the most part, we're talking about computer code, just lines of code.
Okay.
And crucially, unlike, say, a company stock, it's usually not tied to any real-world asset that generates value.
Right. So if I buy Apple stock, I own a tiny piece of a company making phones, selling services.
Exactly. There's production, revenue, something tangible, economically speaking, or futures contracts linked to oil or corn.
But crypto?
Most of it, as McKenzie puts it, they don't do anything. They aren't used for anything productive, in that traditional sense anyway.
So they're not building things or providing services in the same way?
Generally, no. Their main function, the way they took off, was as things to trade, speculative instruments.
Okay, so if they don't do much, where does all that value come from? People just trading them back and forth.
That's pretty much it. Economically, it often looks like a zero-sum game.
Meaning, for me to win, someone else has to lose.
Exactly. The trading itself doesn't usually create new wealth for society as a whole. It's more like shuffling money around. McKenzie compares it to gambling, like poker.
Money moving from pocket to pocket. Makes sense. But the book also talks a lot about the stories, the narratives around crypto.
Oh yeah, that's key. You had this new, confusing asset class.
And maybe a lot of wishful thinking.
Definitely. And, potential for deception. Jim Chanos called this period the golden age of fraud.
I remember that. A feeling that maybe not everyone was being straight. McKenzie felt that too, right? Starting around 2020.
He did. A growing sense that things weren't quite right, that dishonesty was maybe becoming more common.
It did feel like some wild claims were being thrown around. How did that connect to crypto specifically?
Well, Robert Shiller's work on narrative economics is super relevant here.
Okay, what's that?
He talks about economic narratives, basically. Contagious stories that shape how people make financial decisions, what they buy, what they sell.
And these stories can spread.
Like wildfire. And guess what his first example in the book is?
Let me guess.
Bitcoin.
You got it. Bitcoin. He saw it as this perfect example of a viral economic story.
Wow. Can you give an example of how these narratives work in practice?
Think about a bank run. A perfectly healthy bank, right?
Yeah.
But if a rumor starts, a bad narrative saying it's about to fail.
People panic and pull their money out.
Exactly. And that panic, fueled by the story, can actually cause the healthy bank to collapse.
So the narrative creates the reality.
In a way, yes. And what's wild is Shiller published this before the huge crypto boom, before COVID even. He was already talking about how these viruses, narratives, and literal viruses could spread together and mess with the economy.
That's almost eerie. Looking back at the crypto boom, it definitely had bubble characteristics. Any historical parallels jump out. Oh, absolutely. McKenzie makes a really strong comparison to the 2008 subprime mortgage crisis.
Okay, how so?
In both cases, you had messed up incentives all over the place.
Right.
And this widespread belief that prices, housing back then, crypto this time, could only go up forever.
That this time is different delusion.
Always dangerous. And the book points out, history shows these frenzies aren't just about new tech. They tap into basic human psychology, fear of missing out, greed.
FOMO. Big time.
Huge. And it overrides rational thinking, whatever the asset is.
And was there a sense that people weren't being careful enough?
Well, McKenzie argues there wasn't much incentive to be careful. If you're playing with other people's money and you don't think you'll be held accountable.
The risks seem lower, personally.
Right. And remember, the aftermath of 2008, government bailouts, the Fed keeping interest rates super low, pumping money into the system.
Yeah, quantitative easing, QE.
That created this environment of, well, easy money. Lots of capital sloshing around looking for a return.
And how did that connect to Bitcoin showing up?
Bitcoin was partly a reaction against that system. Satoshi Nakamoto's white paper was about a peer-to-peer cash system. No banks, no intermediaries.
Cutting out the middleman.
Exactly. Using the blockchain, this shared decentralized ledger, plus encryption and consensus rules to make sure you couldn't just copy and spend the same digital coin twice.
Solving the double spend problem.
That was the technical challenge, yeah.
So decentralization was key to the appeal. But the book says there was a darker side to that.
Yeah, censorship resistance was the mantra. Financial freedom. But sometimes
It slipped into something else.
it could look more like financial anarchy. Without strong rules, it attracted some less desirable activities. Tax evasion, money laundering.
Ransomware gangs demanding Bitcoin.
That too. And then you had the ICO boom in 2017-18, initial coin offerings.
Like IPOs for crypto?
Kind of, but way less regulated. McKenzie compares it to the dot-com bubble. Billions poured into projects that were sometimes just fancy websites and vague promises.
And
then came the crash. A crypto winter. Prices tanked. Regulators started looking closer.
sounds like that ICO phase, with little oversight, was maybe fertile ground for problems. Which brings us to Shiller's idea of naturally occurring Ponzi schemes. What's that about?
Okay, so a normal Ponzi scheme, right? There's usually one fraudster at the center.
Paying old investors with new investors' money.
Right. But Shiller's idea is that you don't necessarily need that central figure. A Ponzi-like situation can just happen organically.
Oh.
Simply because prices are rising really fast. Schiller says investors, their confidence, buoyed by past price increases, bid up speculative prices further, thereby enticing more investors to do the same.
So the rising price itself becomes the reason to buy. People just assume it'll keep going up.
Pretty much. It creates this feedback loop. FOMO kicks in hard.
And McKenzie saw signs of this in the crypto markets in spring 2021.
Yeah, he felt those dynamics were definitely at play then, when prices were just soaring. There's a famous quote from Charles Kindleberger, an economic historian. He said something like, "The implosion of a bubble always leads to the discovery of frauds and swindles. When the easy money and the hype are flowing, it's really hard to tell what's real innovation and what's just smoke and mirrors, or worse."
Like finding out who's swimming naked when the tide goes out.
Exactly that analogy. And McKenzie points out, before the big securities laws in the 1930s,
The ones requiring companies to disclose information.
yeah, the 33 and 34 Acts, before that, the stock market was much more of a free-for-all. A bit like Keynes' casino capitalism.
And crypto, with its anonymity on the blockchain.
It kind of recreated that lack of transparency, didn't it? Opened the door for deception in ways those old laws were meant to stop.
Okay, so if most crypto wasn't doing anything productive in the traditional sense, how did people justify the crazy prices? What was the argument?
That's the multi-trillion-dollar question, isn't it? McKenzie keeps contrasting it with something like Apple stock. Apple makes things, sells things, earns money. The stock is tied to that.
But crypto.
He quotes the book calling it air, pure securitized air. For many of these things, the value seemed to come purely from the hope that someone else would buy it from you later for more money.
The greater fool theory.
Essentially, yeah. Value based almost entirely on speculation about future price increases.
And the author himself was skeptical enough to bet against Bitcoin.
He was! He shorted Bitcoin, expecting the price to drop significantly by the end of 2021. He said all the marketing he saw, that spring TV ads, billboards, celebs,
Damon.
all of it, it didn't make him confident, it made him nervous, like a sign things were getting overheated.
Which leads perfectly into that emperor's new clothes analogy the book uses.
It's such a good fit, right? The whole phenomenon seemed to rely on everyone agreeing not to point out the obvious.
Because of ego, or fear of looking stupid or missing out.
Probably all of the above. a kind of collective delusion maintained by status seeking and not wanting to be the one left behind.
And McKenzie, the actor with less finance background, positions himself as the kid saying, but the emperor has no clothes.
Right, daring to question this massive industry. And he goes back to Schiller, pointing out how even minor celebrities can help a narrative go viral.
Giving it that mainstream feel, making it seem less risky.
Exactly. It adds that human interest angle, makes people feel more comfortable jumping in.
Now, one specific crypto thing that got a lot of negative attention in the book was Tether. What were the worries there?
Tether was and is hugely important. It's meant to be a stable coin pegged to the US dollar, acting like digital dollars within the crypto trading world.
Okay, sounds useful. What's the problem?
Well, McKenzie lays out a lot of red flags, a company handling billions, but reportedly with very few employees. Never had a full, proper audit to prove it actually held the dollars it claimed to have backing the Tether token.
No audit. For billions.
Nope. And operating through shell companies in places like the Caribbean.
Not exactly confidence-inspiring. What about the people running it?
Also concerning, the CFO had settled charges related to counterfeiting years before. The CEO was almost never seen publicly. The general counsel had links to an old online poker site, Ultimate Bet, that had a massive cheating scandal involving a God mode.
God mode, like they could see other players' cards.
That was the allegation.
Yeah.
So you put all that together, an unaudited offshore company with questionable figures involved, basically running a private money printer for the crypto casinos.
It sounds like the potential for things to go wrong was high.
Extremely high. And then there was academic research suggesting links between Tether printing and Bitcoin price pumps.
Like the Griffin and Shams paper.
That's the one. Is Bitcoin really untethered? It found statistical connections suggesting Tether issuance might have been used to inflate Bitcoin's price back in 2017.
So, potentially market manipulation.
That was the concern. Plus, the anonymity in crypto makes things like wash trading easier,
What's wash trading?
where you basically trade with yourself, buy and sell the same asset to create fake volume and make it look like there's more demand than there really is. Tether could potentially fuel that kind of activity.
So Tether could be used to paint a fake picture of demand, push prices up, and lure in more buyers. Yikes.
It painted a very worrying picture of the foundations of the market, and this was all happening while the market cap was exploding.
Right. The irony McKenzie points out, he's getting more skeptical as crypto hits $3 trillion in value by fall 2021.
It was everywhere. Polls showed something like 16% of American adults had dabbled in crypto.
Now,
And one study suggested over half of Bitcoin investors jumped in during 2021. Peak mania, basically.
it really felt like it was taking over. And the author had this broader theory about an everything bubble.
Yeah, his idea was that years of easy money policies after 2008 had inflated bubbles everywhere. Stocks, real estate, everything.
And crypto was maybe the frothiest part.
Exactly. He predicted that when the Fed finally started raising interest rates to fight inflation, the whole thing would pop. And the most speculative stuff like crypto would fall fastest and hardest.
And was he right?
The timing was maybe a bit early, he admits, but the general prediction turned out to be pretty accurate. He actually doubled down, putting more money into shorting crypto stocks and other firms he thought were suspicious.
Bold move. And fueling all this new investment was that massive celebrity push we talked about.
Oh, yeah. Matt Damon, Gwyneth Paltrow, Reese Witherspoon, Justin Bieber, Steve Aoki,
LeBron James, Tom Brady, Steph Curry.
Aaron Rodgers. The list goes on. Big names telling people to get into crypto. Tom Brady and Gisele Bündchen were heavily involved with FTX. Equity stakes, Gisele was even their ESG advisor.
ESG, environmental social governance, for a crypto exchange.
Yep. And the peak of it all, McKenzie says, was the Super Bowl. Just wall-to-wall crypto ads.
The pinnacle of American marketing, right? Used to sell crypto.
Pretty much. It was impossible to ignore. And the language within crypto, it had its own kind of code, didn't it? McKenzie definitely pokes fun at the jargon. Ecosystem, the space, Web3, often used in ways that sounded impressive but maybe didn't mean much.
Obfuscation rather than clarification.
Sometimes felt like it. He calls the very idea of calling these speculative things money the original linguistic sin. Set the wrong frame from the start.
Right. And what about the influencers pushing this stuff online?
He compares them pretty directly to people pushing multi-level marketing schemes, MLMs.
Ouch.
using Twitter, YouTube, TikTok, Telegram, Discord, constantly hyping coins based on flimsy fundamentals, rumors, often just straight up misinformation.
All aimed at recruiting more buyers.
Looked a lot like it. Very similar dynamics to pyramid schemes, really, dependent on new money coming in, because the tokens themselves often didn't do anything except hopefully number go up.
Just needed more people to believe. But despite that, there was a real sense of community, wasn't there? People felt they belonged to something.
There was definitely that appeal. McKenzie acknowledges that for people feeling let down by banks, by the government, by the traditional economy, crypto offered this alternative. A community, a shared goal, getting rich together.
A sense of being on the inside of something new.
Right. But he's critical of the whole trust the code idea.
Why is that?
Because code isn't magic. People write it. Fallible people. And most cryptos, apart from maybe Bitcoin, are basically securities issued by companies. There's still centralization, still human decisions and errors involved.
So the trustless idea didn't always hold up. The book also steps back to talk about what money is fundamentally.
Which is crucial context, right? Money is basically a social agreement. We all agree this piece of paper, these numbers in a bank account have value.
It's based on consensus.
Exactly. We kind of take the stability of the US dollar for granted. But McKenzie points to history, like the wildcat banking era in the US in the 1800s.
What was that?
Tons of private banks issuing their own money, often poorly managed, lots of fraud. Some banks set up in remote swamps so people couldn't easily come and redeem their notes.
Seriously.
Yeah. Eventually, central banks were created partly to stop that chaos and make deposits safer.
So these systems evolved because the old ways failed.
Right. And the argument McKenzie makes is that financial systems, like money itself, are social constructs. We discard things that don't work private money, the gold standard. He suggests maybe crypto is another one of those failed experiments.
Interesting perspective. Going back to the marketing blitz, the Super Bowl ads, you said the book saw those as a potential peak.
Yeah, the thinking was if the market relies on constantly bringing in new buyers, like a Ponzi.
You eventually run out of people.
Exactly. Spending that kind of money on mainstream ads like the Super Bowl might mean you're getting desperate for new recruits. Maybe it was the high watermark, the peak of the madness.
A sign the pool of potential buyers was drying up. And the book is clear about who to blame when things went south, right?
Very clear. It argues we need to blame the powerful people and the flawed systems that allowed the fraud and speculation, not just the ordinary folks who bought in, hoping to improve their situation.
Some took risks knowingly, sure, but the environment itself was problematic.
Right. The lack of regulation, the misleading hype, those are systemic issues.
And amidst all the hype, there was a counter-narrative growing. The crypto skeptics.
Yes, McKenzie talks about finding this community online. Really diverse group, researchers, economists, journalists, former regulators.
People questioning the official story.
People digging into the details, sharing information, supporting each other. He found it invaluable in trying to figure out what was really going on, especially facing such a well-funded industry.
And his own journey to figure things out took him to some weird places, starting with SXSW.
Yeah, South by Southwest in Austin, early 2022. He organized a panel of skeptics there. First time really diving into the crypto world in person.
What was that like?
Pretty strange, based on his account. Visited a blockchain creative labs thing run by Fox Entertainment.
Fox, the media giant leading a decentralization revolution.
The irony wasn't lost on him. Then he met various crypto enthusiasts. Some seemed genuine, others a bit off. Like these two guys, Charles and Paul, who knew surprisingly little about crypto, but hinted they worked with the FBI or CIA.
Seriously.
Yeah, led to a surreal dinner talking about geopolitics, 5G security, China, the NSA allegedly bugging Signal. Just bizarre stuff. Followed by a TikTok party where the same guys were paranoid about the Chinese app. Very weird.
That was completely surreal. Did he get to talk to any big names there?
He briefly encountered Alex Mashinsky, the CEO of Celsius, tried to get an interview, and of course, held the skeptic panel itself.
And from the weirdness of SXSW, he went somewhere very different, a Bitcoin mine.
Right, out to Rockdale, Texas, visited the Windstone facility, later bought by Riot Blockchain, biggest Bitcoin mine in the US at the time.
What was that like?
Intense. Apparently, they initially wanted NDAs signed, but the journalists refused. Met the CEO, Chad Harris. Interesting guy saw Bitcoin almost as a byproduct, focused more on building infrastructure, creating jobs in a town that needed them. Very Texas, very right-wing politics around Bitcoin there.
And the mine itself.
Overwhelming, warehouses full of machines. The air-cooled ones were incredibly hot and loud, like a million digital locusts, but the newer ones, cooled with mineral oil, were eerily silent.
Gives you a sense of the sheer scale and energy involved.
Definitely highlights the environmental questions too.
And the book also looked closely at the big exchanges, like Binance.
Yeah, McKenzie wrote about Binance for the Washington Post, pointed out how it was basically a whole crypto economy in one company exchange, lender, token issuer, trading on its own platform.
That sounds like massive conflicts of interest.
Huge! Things that are strictly separated in traditional finance to prevent manipulation. Binance defended it as market making, but the potential for abuse is obvious.
And these exchanges operate offshore, mostly.
Mostly, yeah. In legal gray areas, often completely unregulated, playing all these conflicting roles.
Not a recipe for trust. Then came the Bitcoin 2022 conference in Miami. Sounds like that was quite the scene.
Oh, definitely. McKenzie filmed a lot there. Peter Thiel was on stage throwing $100 bills, calling Warren Buffett a sociopathic grandpa. Jordan Peterson was there too.
Wow, quite the crowd.
He described the community there as less about shared ideals and more about commerce. The timeless American fantasy of getting rich quick, lots of MLM style selling, lots of parties.
Any memorable encounters?
Ran into Brock Pierce again, the former child actor, Tether co-founder.
What happened this time?
Pierce apparently bragged about talking to loads of world leaders. McKenzie pressed him on why Tether still hadn't been audited.
Yeah, well.
Got contradictory answers. First, Pierce said they were working with a big firm, then said hundreds had tried and failed. Blamed lack of regulatory clarity.
That sounds like an excuse.
Pierce even compared it to Arthur Andersen going under after auditing Enron, saying auditing crypto was too high risk.
Enron was a fraud. That's why Anderson went down.
McKenzie pointed that out. Pierce then vaguely mentioned high-level talks with our government and the National Security Council. Just sounded unbelievable. Saw people wearing El Salvador Bitcoin bond t-shirts, even though the bonds hadn't actually materialized.
Right, El Salvador. The book goes there next.
Yep. Flew down to investigate Bukele's Bitcoin experiment. Met critics who'd faced serious trouble, like Mario Gomez, arrested without charge. Heard about Carmen Valeria Escobar, another critic.
What was the rationale for El Salvador adopting Bitcoin anyway?
Bukele claimed it would help with remittances, boost tourism with Bitcoin nomads, attract investment, make El Salvador like a crypto Switzerland.
Did it work?
Well, the rollout in September 2021 was chaotic. The global crypto market crashed that day. They tried buying Bitcoin with an ATM, got hit with a 10% fee, no real identity checks.
Not great. And what about Mario Garcia, the critic who got arrested?
His story was harrowing. Jailed under Bukele's state of emergency, terrible conditions, really highlights the risks of opposing the government there.
And the Bitcoin City project.
Visited the proposed site near La Union, supposedly funded by volcano bonds, powered by geothermal energy. Big plans, including a new airport. Met Wilfredo Claros, a fisherman whose land was being taken for the airport. Offered very little money, facing eviction from his home. Saw trees on his property marked for removal. His neighbor's elderly mother was traumatized by the threat.
Heartbreaking. Using Bitcoin as a pretext for displacing people.
Seemed like it. And then news broke from El Faro, the investigative outlet. Leaked audio revealed Bukele's government secretly cut a deal with MS-13, the opposite of their public claims about crushing the gangs. Journalists questioning the government face spyware attacks, intimidation.
Man, that's dark. So while this is happening in El Salvador, the wider crypto market starts to wobble in spring 2022.
Big time. But VC money was still pouring in. Then came May 2022. Terra Luna collapsed.
That was huge.
Massive. The UST stablecoin lost its peg. The El Luna Nay token imploded. They even halted the blockchain. Duquan's infamous deploying more capital steady lads tweet became a meme as billions vanished.
And then Celsius.
Right after, Celsius Network froze withdrawals. Turned out they were deeply over-leveraged, made crazy risky bets. CEO Alex Mashinsky vanished from public view. They ended up calling Citigroup for help.
The irony. Unbank yourself, then call Citi.
Exactly. And the reaction from parts of the crypto crowd. Lots of DYOR, do your own research, and not your keys, not your coins. basically blaming the victims.
Not a good look.
Felt very much like the subprime crisis again. Hillary Allen, a law professor, compared DeFi to shadow banking's same problems: leverage, rigidity, complexity, all leading to fragility, bank runs.
So even if some parts had potential, the whole unregulated system was the problem.
That's the argument. It could even act as a smokescreen for fraud. And the bankruptcies revealed how interconnected everyone was. Celsius owed money to Tether, for instance.
And wasn't Sam Bankman-Fried sniffing around Celsius's assets?
Reportedly, yeah. Meanwhile, the Celsius customers were fighting amongst themselves in bankruptcy court. Just a mess.
Which brings us to the fall of FTX itself. How did that start to unravel?
Well, back in July 2022, Brett Harrison, president of FTX US, tweeted misleading stuff about FDIC insurance.
Not true.
Definitely not for crypto assets. Then McKenzie interviewed SBF himself that same month.
How did that go?
SBF apparently got really uncomfortable talking about crypto having no inherent value. Blamed the downturn on macro factors, Fed rate hikes.
Did electing.
Seemed like it. McKenzie pushed him on platforms like Voyager and Celsius freezing withdrawals. SBF made vague claims about stablecoins being roughly backed. Estimated maybe $200 billion of real money was left in crypto.
And the Tether question came up.
Oh yeah. McKenzie listed all the concerns: lack of audit, weird personnel. SBF apparently laughed nervously, gave a long, rambling answer about market makers, and only belatedly admitted Terra Luna was obviously risky.
What about his political donations?
Yeah.
He gave a lot, right?
Massive amounts, mostly to Democrats publicly. McKenzie asked about it. SBF was cagey, didn't want to give numbers, even though Open Secrets had the data.
Dodging again.
Then, after the interview, SBF apparently said off the record that the Tether guys were emotional, just added to the suspicion about why Tether wasn't audited.
It sounds like even then, people maybe thought SBF was untouchable. Too big, too smart.
Even skeptics kind of assumed FTX was massively profitable, that SBF had it all figured out. But McKenzie had this nagging thought: SBF loved games. What other games was he playing?
Chilling question. And politically, the industry seemed pretty well connected by then.
Absolutely. Felt like a tipping point where the flaws were obvious, but politicians weren't acting, maybe because of all the lobbying money.
Crypto was spending big in DC.
Huge amounts, forming lobbying groups, patsies, showering donations on both parties, more than industries like pharma or defense, apparently.
Wow, SBF and Ryan Salami were major donors.
Top tier, spreading it around. McKenzie went to DC, said you could feel the impact. Politicians suddenly praising blockchain. Senators like Toomey, Loomis, who owned Bitcoin Gillibrand, seemed crypto-friendly.
Did talking to staff help?
Staffers seemed concerned, understood the risks, but said action was slow. Politics, upcoming election, plus the weird U.S. system splitting regulation between the SEC for securities and the CFTC for commodities.
Right. How did crypto fit into that?
Most cryptos looked a lot like illegal securities under the Howey test, basically unregistered offerings, often Ponzi-like. The SEC even had a checklist of red flags that fit perfectly.
But Bitcoin was called a commodity.
Yeah, mostly because the CFTC regulated derivatives and Bitcoin futures existed, even though it wasn't really like corn or oil, and ownership of mining was pretty centralized. Talked to John Reed Stark, former SEC enforcement chief, who was very critical.
It seems like the regulatory system wasn't really equipped for this. Around this time, the book introduces James Block, Dirty Bubble Media.
Right. James was one of the first really digging into Celsius, saw the crazy high yields they offer and thought, this looks suspicious, like Madoff level returns.
What did he find?
Started finding holes in CEO Alex Mashinsky's background story, exaggerated or maybe fabricated parts of his resume.
And when he reported it?
Celsius, or people connected to them, apparently tried to silence him. DMCA takedown notices got his account suspended. There were even reports linking Celsius to organized crime figures in Israel.
So Celsius was just a Ponzi.
Basically, yeah. Lied about being solvent, executives cashed out millions, critics got attacked, and Celsius was deeply tied to Tether, even as it went bankrupt.
And then just days after SBF's off-the-record chat with McKenzie.
James Block publishes that post. Is Alameda Research insolvent?
Oh.
Changed everything. Before that, people thought Alameda was this genius trading firm funding FTX.
But it wasn't.
Turns out, no. Then CZ at Binance tweets he's dumping Binance's holdings of FTT, the FTX token. Alameda's balance sheet apparently relied heavily on FTT.
Triggering the bank run.
Exactly. SBF tries to engage CZ on Twitter. CZ basically laughs him off, posts a crying emoji about still holding worthless Lunae. Then, election day in the US, FTX announces it's selling to Binance. SBF capitulates.
The myth just evaporated. Alameda wasn't geniuses.
Nope. Poorly run hedge fund lost billions before 2022. The story about their early profits from the kimchi premium arbitrage was disputed. A former colleague said they lost those gains quickly.
So they had to find other ways to make money. Riskier ways?
Seems like it. Market making on FTX, then bigger directional bets. Caroline Ellison, Alameda's CEO, had tweeted about focusing on predicting markets, not just small arbitrage. Maybe they made a huge wrong bet.
And SBF admitted secretly donating to Republicans, too.
Yeah, in an interview, claimed he gave equally via dark money so the media wouldn't freak out, just more deception.
After FTX, it felt like anyone could be next, right?
Total loss of trust. Trading volumes plunged. Binance gained market share, but the whole pie was shrinking and regulators were circling them too. DOJ investigation.
People started pulling money from Binance.
Yeah, big withdrawals in December 2022. They tried to calm nerves with a proof of reserves report from Mazars, an accounting firm.
Did that work?
Not really. Mazars quickly distanced itself, said it wasn't a full audit, and stopped doing crypto work. Didn't help confidence much.
Amidst all this financial carnage, the book brings in a very personal story. Harold Henson.
It's incredibly important context. David Henson, a pastor, told McKenzie about his father, Harold.
What happened?
Harold had always dreamed of Wall Street, worked in sales, but kept getting drawn into MLM schemes. Later, got obsessed with Forex trading.
Which is super risky for retail investors, right?
Hugely risky, negative expected value for most. David warned him, but Harold geared deeper in, more desperate. The book mentions how crypto addiction mirrors gambling addiction, dopamine hits, illusion of control, chasing losses.
But crypto addicts often think they're smart investors.
Exactly. Extreme confidence, blind to the losses. Harold got involved with a thing called stallion wings through a self-directed IRA. It looked like a total scam.
How did it end?
Badly. Initial fake profits, then trouble withdrawing, demands for tips, fees. Harold got desperate, took out home equity, loans against his job, life insurance, 401k, maxed credit cards, borrowed from relatives.
Oh no.
David's last talk with him, Hal asked for $5,000. David refused the money, but offered help. Hal got angry. It's like the old online poker boom, easy access, potential for addiction, then crackdowns.
What happened to Harold?
Tragically, he died by suicide. David found the emails with stallion wings. He'd never even met them in person, just online promises.
Devastating.
David felt his father was basically murdered by the scheme, preying on his desire to provide for his family. The last email Hal sent them said he was suicidal. Their reply, one word, sorry.
That's horrific.
The book reflects on how the American dream gets twisted into this casino mentality, how these zero-sum games are fundamentally antisocial, the huge societal cost of fraud. Argues capitalism needs to change.
A powerful and necessary reminder of the human element. And the book ends with McKenzie testifying in Congress.
Yeah, Senate Banking Committee, December 2022. Right after FTX collapsed, Hillary Allen was there too, Kevin O'Leary.
What did McKenzie say?
Called the crypto industry the largest Ponzi scheme in history. The epilogue notes subsequent guilty pleas from FTX execs, the NY Attorney General suing Mashinsky for fraud, DOJ going after Bitslotto for money laundering linked to Binance.
So some accountability.
Some starting to happen, but El Salvador was still pushing Bitcoin, talking about issuing those volcano bonds. And Wilfredo Claros, the fisherman, still facing eviction for the Bitcoin City airport.
The story wasn't over.
Not at all. The book ends with a little story about playing Monopoly Junior with his daughter. Faster, more luck-based, maybe a reflection of modern capitalism. They agree to a tie based on trust and plenty of paper stuff called money.
Brings it right back to trust and social consensus.
Exactly. And acknowledgments to experts, journalists, his wife, plus that helpful SEC checklist of Ponzi red flags in the appendix.
So wrapping up this whole deep dive into easy money, what's the single biggest takeaway?
I think it's the uncovering of this really complex, often dark reality behind the shiny crypto facade. You see these repeating cycles, bubbles, fake narratives, lack of regulation, and real human suffering. That's the core story here.
It's definitely a cautionary tale For our listeners who want to get up to speed quickly but properly, hopefully this has been a good shortcut to grasping those key issues.
It really forces you to ask, what's next? How do we handle digital assets going forward? How do we balance innovation with protecting people? And fundamentally, what does it take to maintain trust in any system of money? That's the big question to ponder.